Okay, so here's my introduction to pivots and how to be consistently profitable like an institutional trader, not like a retail trader. So first, the big difference is that a retail trader usually would use an algo or some sort of confirmation in order to get into a trade. And if you would just connect like a line here, this just shows how institutional traders will always win over retail traders. So here, a retail trader might make this trend line and they won't know what happens here. So here, we'll go back here, they see this trend going up. So they'll connect the bottoms, it breaks this resistance right here, that pivot and that resistance. So they would buy on this gap down, or they would sell on that gap down, and that's when institutional traders would buy, because they need to get filled with millions and millions of dollars. So you have to think, how do they get in at a specific price level? So most of them usually generally use pivots. So I'm going to show you my pivot strategy and how you can be consistently profitable. So let's see, this is NVIDIA, and I think I'll just show you here first. So I'm going to first draw a couple pivots. So I'm going to take the pivot over here from this high. I'm going to try and get as accurate as possible. This is the 1 hour chart. And then I'm going to take this pivot right here. This was its previous resistance that it broke out. And then I'm also going to find one support level. And you see it right there, these highs. And then over here, these lows. So it used a resistance as a support. And so I'm going to pick that up as well. And I'm going to pick the low of the closest price level. So this was further away and this is closer to the near date. And I'm not caring about this so much because a pivot is not necessarily an exact price level, but it's an area of support and resistance. And then I have one other key thing to look at here. So it gapped up right here. And so I'm going to draw another pivot at the bottom of this gap, and I'm going to make it a green line to represent the gap. And I'm going to make this one green as well, so that you can understand this from green line to green line is where it gapped up. And the red is that all-time resistance, and this one is just from a different price level. So now, from here, I would go down to the 15-minute from the 1 hour, and I would look at a specific price level from the past 3 to 4 days. So here we saw that it gapped down, and then it slowly worked its way up to fill that gap. And it even broke up a little higher to show that bulls were really wanting to push this back up to this level. And then it gapped up again from this green to this green. I'm going to adjust this just a little bit to make it on that open right there. Make it a little more accurate. So now when I'm looking at this price action, I'm noticing that it did break a new high. And that might be a signal for retail traders to get in, which is just a really easy spot for institutional traders to take profit. Because if we go to the 1 hour, you can see that that is, and even the daily, that is a long high. It hasn't been up there in a couple months. And it's all about the past couple months. You don't really necessarily want to look like, oh look, back last year it made it up to 291. And you want to keep track. I say generally the last 3 months is a really good predictor of what's actually happening. And here it looks like NVIDIA is in an upward trending. However, it got rejected at this level twice, 1, 2, and then a third time. So it tried to break up, but I don't think it's gonna. We'll take a look here. Back to it. Alright, so it broke up here and it got rejected. And so once it broke back down this red line from previous highs over here, that would be a good signal for me for a good price level to get in puts. Now by this, I don't mean you need to get into a put the instant it crosses this line down. Because look, it hits that same price level 1, 2, 3, 4, 5, 6, almost 7 times. Do you see that? How that wick right there and this wick right there are almost all at that same price level of this red line. So that means you had 7 different entries in order to get into a put. And so one of my general rules is that when you go to a 5-minute chart, and when you see it keep getting rejected at the same price level, that's a good indication that it is going to bounce off resistance or support, whichever way it is going. So whichever way the rejection is coming from. In this case, it's getting rejected from the top. It's coming down. So here, when it bounces up, this would be the setup right here. So if you didn't get in here on this breakdown, so here I would also pull up some couple different things. I really like on balance volume lately, and not so much MACD and everything else, because it's just really hard to tell what is actually going on. And then I go to the extended so that it really paints a good picture of what's going on. So here we see the volume spiked up, the strength spiked up here, and if you would draw a line similar here with the volume, and here we had on the 5 minute, we had this wedge was broken down here. And so look at that, you had all of this time to debate, was it going to break higher or was it going to stay below that line? And so if you were only looking at the 5 minute chart, you'd be like, oh, it's definitely breaking up. Look at all that volume in the morning right here. That's just a pump. That really doesn't mean a whole lot unless it holds this high. Because if you go to the 1 hour, we can clearly see that the same level here and here, and how it got quickly rejected. That's what the wick means. So it went up, but it did not hold, and it came back down. And even on the volume in the RSI, we have a divergence. So if you look here, there's more volume at this price level than this price level, and the relative strength was also much higher at this price level than at this price level. But then why would this one be higher? Well, that's just a really good signal for bearish divergence, which means this is likely to continue back down because it had more strength here than it did here. So it's more likely to be oversold here. So that was what gave me the really good indication that this is going to fill this gap down. So once I saw this from last Friday, this really strong bearish wick, it got oversold and then quickly picked back up. To me, that just means that the bears are attempting to make it lower because it did break this open right there, right here. So essentially, I'm not looking for a specific cross in the RSI or the unbalanced volume. All I'm using this for is a guide from where it was previously. So if I wanted to get into a put, I would say, well, where is the volume or the RSI crossing down? So like here, the RSI crossed down from those bottoms, and you really got to go to extended for this because always you just get a very inaccurate feeling. So if we're going to take bottoms here, we would never really get anything. Well, actually, we'd be like, what the heck's going on? Because here, the price level is at almost the same price level it was at last Friday, but the volume is almost a million down. So that's another good sign that this resistance here is going to hold. So it did just break up now. But all I'm thinking is that this gap right here is likely to retest several times, and it might even push up until there. You see, because this is where these lows and highs are. So I'd say somewhere between here and here, there's going to be a lot of downward resistance. So if the price level comes up here, it's going to get rejected back down. And eventually, it'll get to this green line right here, this 183.77. So I'm thinking that anywhere by this red line was a good spot for a put, as well as in this line, this green box. I'll make it red to represent resistance. So you see how it just jumped up like that? That would be a good spot to enter lightly on a put, because your good entry was up here this morning, or that was yesterday, my bad. So yeah, it actually would be up here. This would be good. And if you were looking for a call, and I would only say between or near you see I picked that bottom right there, and then I come all the way down to there. So if you were looking for a call, the price level that you wanted would be below these levels right here. You see how that wick came down? So like this one you might not want, but this one you might say, hey, if it's gonna fill, it might go down only for another 50 cents before it rides back up like $3. So it really depends on how aggressive you want to be, and that's where you can use technical analysis. Be like, hey, is it oversold? Is the volume gonna come back up like right here? And that's where you can use your different indicators. I like this is the one for the 100 SMA. Yeah, I'll show you. So I've got the 100 moving average, 100 SMA, and the 200 SMA. So this is the 100 SMA, the 200 SMA, and the 100 moving average. And if you go to the 3 minute, I think that the 200 SMA works really well for bouncing. And the 5 minute, the 100 SMA, so there's orange one, and then the 1 hour, the white line. Beautiful. This is the high probability one right here. But anyways, I hope you get the point. What I'm trying to make is that you don't, like right here, this is a trap for retail traders. What I mean by that is, look, it broke a previous low and it crosses down and you're like, oh crap, look at that, it's breaking down, I don't want to miss this big drop. And so you get in, it drops like 50 cents real fast and you're like, hell yeah, and then it just shoots back up and doesn't come down all day and you're like, fuck. So that's why you can't always just trade setups. You need to have a specific price level in mind where you will enter, and then another specific price level where you will get out. So if I want to get in puts here, I would say these bottoms right here is my exit for puts. So if I get in a put right here, it goes down and it comes back up, it hits this price level, I'm out, because I'm only scalping short swings, very short swings. If I was swinging long, then I would definitely not get in there, because I would want a better entry at a specific price level. Because if you're going in long, it doesn't matter short term, it all is long term. So if it shoots up and you're like, I am long on this going back down, and it just broke a previous high, as soon as it breaks back down anywhere at that price level, that'd be fine for a long put, because you're saying to yourself, that's a long term high, it's bound to come back down. That would be the logic behind a long put. And then you just have different targets, and then you would say, well, if it goes up to 190, I'm gonna get out, because you need to have a specific exit and entry for every trade, and it cannot be like a wedge or a pivot. It needs to come along with confluence with other types of setups, which I use the 1 hour 100 moving average and the daily. The daily 100 moving average is very accurate for pivots. And then I really like to use the 3 minute with the one, which is the 100 moving average, 100 smooth moving average, and the 200 SMA. And what I will do is I will pull up this 4 chart and I will put the same stock on every single one. And by doing this, I'll put this on the 3, this on the 5, this on the 15, and this on the 1 hour. And what this does is it forces me to think long term. So when there's a little spike up, like we just saw here, and I'm like, oh shit, was I wrong? Should have been in calls because it's breaking out. No. If you look in the 5 minute, in the 15 minute, it's a lot easier to see that bullish divergence, especially on the 1 hour. Remember when I showed you that? How the unbalanced volume had made on the 1 hour, it made a lower volume, a lower RSI, and a lower MACD. This signal, and the price went higher. And you don't understand what I'm saying. Look at this. So the trend is up here. The trend is down, is down, is down. So unless it breaks back up for this and makes higher highs, this is a great opportunity for a long or a medium swing put down because of this bearish divergence. Or what I like to do is just a short swing. So that's all price level. So here, anywhere near this red line, great opportunities. And it doesn't have to be exact. Like here, it got really close and you're like, oh, I'm not going to get in until there. You know, maybe that's not the trade you want then. You know, but the thing is, nothing's ever perfect. Like you can't just say, oh, if it doesn't make it to this exact line, or if it crosses this line, I'm going to sell. You know, it's got to be a pivot area. It cannot be exact. But that's the whole idea, is that you get it close to that exact price. And by setting targets like this, you'll be able to be much more consistent in deciding if you're going to be in calls or puts and at what price level. Because say you're really determined on calls, right? And it just shoots up in the morning, right? And you're like, holy shit, this is going up. It just broke a new high. And you get in here and it's down the rest of the day. You're like, well, what the fuck? That's why you need to set a price level to get in at. If you set a price level here or here and say, I'm going to get calls here, and I'm going to take profit at this red line, or I'm going to get calls anywhere at this green line near the open, and I'm going to take profit near this red line. So if it gets up here, it gets rejected. Comes up again, it gets rejected. You're like, all right, well, maybe I should just take my profits. I think that might be it. It got rejected twice. The third time it comes up, I'm going to take profits. Or maybe you just say, hey, I think that's it. The next little dip up, I'm out. I'm going to take my profit. And it's the same way for down. So if it breaks down and it just shoots down in the morning, you want to get in a put, you can't get in a put down here because it already filled the gap. You got to get in a put at this resistance. So you might not get in until 11 or 12 o'clock, you see? But the patience is the biggest part. And if you can align your trading personality with a specific strategy, you got to write it all out. And then make a table. You say, was I patient? Did I make an emotional trade? Did I sell out early? Did I make an improper, too tight of a stop? Did I get in here and put my stop right there, and then I get stopped out here, and then it shoots up? You know, you got to be very, very predetermined with everything. You don't want to be in the moment. You don't want to just make those decisions as they happen, because intuition in trading will never take you the right way. Never. Intuition in trading will never make you win. You will lose every time if you try to trade intuitively. Because that's how the market is set up. I'm just telling you right now, look at that. You remember when I just told you how it shot up? How I'm telling you, that's exactly what I'm talking about. So if you got any other questions, let me know, and I am down to make more videos later this week. So have a great day.